Hey everybody, it's Mattia, and we're talking about Chapter 17, Accounting and Financial Information. You're in the right place if you're not taking Accounting 201 at Bonas right now, or you didn't take accounting in high school. Hope you enjoy. Chapter 17 is titled Accounting and Financial Information. Let's get started. First, some general background on accounting. Accounting is an information system that measures business activities and reports financial information to users. Definitely write that definition down because it's going to be on the quiz. Who are these users? They could be investors, creditors, managers, owners, employees, or government regulators. There are two main fields of accounting: financial accounting and managerial accounting. Financial accounting provides information to external users. Those are our investors, creditors, and the government. Managerial accounting provides information to internal users. Those are our managers, owners, and employees. We're going to start by talking about the basic accounting equation. The basic accounting equation is assets equals liabilities plus owner's equity. It's also commonly rewritten as assets minus liabilities equals owner's equity. They're exactly the same thing, just a little bit of algebra. If you remember one thing about the accounting equation, it's that it always has to be balanced. Here's why. The first category is assets. That's what we own. Next, we have liabilities, which is what we owe. And finally, owner's equity, which is what is left over. That's why the accounting equation will always be in balance, because if we subtract what we owe from what we own, we'll always have what is left over. Owner's equity and stockholders' equity are the same exact term. You'll probably see them used interchangeably. It really just depends on the size of an organization. If there's only a few owners, you'll see owner's equity, whereas in a large publicly traded corporation, you may see stockholders' equity. We're going to be talking about four basic financial statements in accounting. The first financial statement is called the balance sheet, and the basis of it is the basic accounting equation. The balance sheet is a snapshot of an entity's financial position at a certain date or time. Many financial statements will be for a given time period, but the balance sheet isn't. It's always right here, right now. What's the financial position of our company? The balance sheet, just like the equation, contains those three major categories: assets, liabilities, and owner's equity. Let's talk about assets. Assets are economic resources of an entity that are expected to produce future benefits. There are many types of assets. The first and most popular is cash. We could have equipment, buildings, and land, often called PP&E, property, plant, and equipment. We have inventory. If we're making these products and we're storing them and getting them ready to sell, they're things we've made and we're going to sell them. That's definitely going to produce a future economic benefit. And then accounts receivable, what our customers owe us when buying on credit. Say company XYZ buys 100 widgets from us, but they don't pay cash up front. We issue them an invoice, and they owe us for those 100 widgets. That's an asset because we expect that we're going to be paid for it. Next on the balance sheet are liabilities. Liabilities are claims against an entity's assets by creditors or vendors. Basically, liabilities are our debts. It's what we owe others. There's several types of liabilities, and a couple of them are below. Accounts payable, which is the opposite of accounts receivable. This is what we owe for what we've bought on credit. Say we buy 100 computers from company XYZ, they issue us an invoice if we didn't pay them in cash up front, and we owe them the money for those computers, generally within 30 or 60 days. This is a liability. Salaries and wages payable, which is what we owe our employees for working for us. And lastly, notes payable. This is what we owe for current or long-term loans from a bank or other creditor. Last, owner's equity. And owner's equity is the claims made against an entity's assets by its owners or its stockholders. What does this mean? After we've paid our debts, it's what's left over that belongs to our owners or stockholders. There are a couple types of owner's equity. First is paid-in capital. This is what our owners invested, maybe what they paid to start the company, or common stock, which is the money we've received from stock issued to shareholders. Then retained earnings. This is the cumulative profit of what we've made over the life of a business. The next statement we'll talk about is the income statement. The income statement reports an entity's financial performance for a given time period. So perhaps in the year 2013, we have an income statement. This is going to show us how we did. The income statement contains two major categories: revenue and expenses. Revenue, the amount earned from goods and services, and expenses, the cost of doing business. The bottom line of the income statement is net income. And the simple format, although it's generally much longer than this, is revenues minus expenses equals net income. And within revenues and expenses, we're going to break that down into types of revenue and types of expenses, but more to come on that later. The third of the four basic financial statements is the statement of retained earnings. The statement of retained earnings shows how a company's retained earnings changes over the course of a year. The basic format of the statement of retained earnings is as follows. We take beginning retained earnings at the beginning of the year, and we add in our net income for that year. Then we subtract our dividends for the year. Dividends are a portion of our company's earnings distributed to stockholders or owners. For example, if I own a business with a partner of mine, we're usually going to take a certain portion of earnings out at the end of the year as owners. Likewise, for large corporations, Apple, although they didn't for a while, decided to issue a dividend to their stockholders. They take a small percentage of the profit for the year and give it to all their millions of shareholders. Then we reach ending retained earnings. This is the balance that we carry forward and retain earnings into the next year. The statement of cash flows, or cash flow statement, is the fourth of the four basic financial statements. The cash flow statement shows the sources and uses of a company's cash during the year. Why is this important? Well, ask Lori or any other business owner. Cash is king. And there are three categories on the statement of cash flows: operating, investing, and financing. Operating is cash flows related to the selling of goods and services. Investing is cash flow related to investments in long-term assets. And financing is cash flow related to long-term liabilities and our equity or stock. In the book, you're going to see a great diagram on the accounting system, which is the overall real purpose and what happens behind the scenes in accounting. We start with our inputs, our accounting documents. These are sales documents, receipts from what we've bought, what we've sold, payroll records to our employees, bank records, travel and entertainment, all of those receipts and all of the records of things we've bought or sold, anything we've done with our money. Next, we process all of that information. Entries are made into journals, and then the effects of these journal entries are transferred or posted to what we call ledgers. We'll have those terms in a minute. Then all these accounts are summarized into a trial balance. And finally, our outputs are our financial statements. The book only mentions three, but most accounts will tell you there are four: balance sheet, income statement, statement of cash flows, and the statement of retained earnings. Some of the basic terms of what we just discussed: a journal is a chronological record of business transactions. This is where we would post what we've bought or what we've sold in a chronological order throughout perhaps a month. Then the ledger. This is a collection of what are called T accounts, where we post transactions from the journal. And finally, our trial balance is a collection of all the accounts and their ending balances, where the amounts are verified to be correct and balanced before going to the financial statements. And finally, we have our accounting cycle. This is a 6-step process which describes what happens to all of our accounting information. This is basically a deep dive breakdown into the accounting system. We start by analyzing our source documents, sales slips, travel records, etc. We record transactions into the journal. Then we post journal entries into the ledger. Then we take a trial balance, make sure everything is all balanced and correct before we prepare our financial statements. And then last but not least, we analyze our financial statements, which is where we look at how the company did and how it can improve. We'll be studying more about that in later chapters. So there's just a very short intro into accounting. It's really a huge topic, and it finds its way into almost every major business discipline. Accounting is often called the language of business, and it's important in almost everything we do. Don't worry if you're feeling confused though. Lori and I are always here for questions, and we're going to be doing more in accounting and finance over the next week or so. See you in class.